Imagine a digital asset that started small, almost unnoticed, but has quietly, almost imperceptibly, grown into a multi-hundred-billion-dollar market.
Hmm.
We're talking about stablecoins, these fascinating digital assets that now facilitate, what, over 120 million monthly transactions globally?
That's right.
They've truly become this silent yet incredibly powerful force in global finance.
Hmm.
But for a long time, this space was, shall we say, the digital equivalent of the Wild West.
Absolutely. A lot of uncertainty.
Yeah, huge uncertainty for businesses, and crucially, significant risks for you, the user. We saw tangible examples of this, like the truly dramatic 2022 Terra Luna collapse.
A real wake-up call.
Right. Which really highlighted the vulnerabilities when things went wrong, and the lack of clear rules just left everyone scrambling.
And what's fascinating here is just how quickly that landscape changed from something resembling, well, chaos to a real clamor for clarity. The market cap for stablecoins surged past $200 billion by early 2025. And with that kind of growth and the sheer volume of transactions, the calls for clear federal rules became absolutely undeniable.
That surge really underscored the urgency, didn't it? After operating for so long in this sort of regulatory gray area, what exactly has happened to bring order to this space?
Well, the U.S. government has just made a landmark move that promises to do just that. We're talking about the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or, as it's better known, the Genius Act of 2025.
The Genius Act.
Yeah, and this deep dive is all about exploring what this act is, why it was so desperately needed, its core provisions, and, its far-reaching implications for digital assets, for financial stability, and even for the U.S. dollar's global standing.
So a stage was set for this act, which passed the U.S. Senate on June 17, 2025. And it passed with a really strong bipartisan vote, 68-30. It's a big deal, but at its heart, what does the Genius Act actually do?
Okay, so at its core, the Genius Act aims to regulate what it very precisely defines as a payment stablecoin.
Payment stablecoin. Okay.
Think of it this way. It's a digital asset specifically designed to maintain a stable value. Usually, it's pegged one-to-one to a national currency like the US dollar.
Right.
And its primary purpose is for payment or settlement. That makes it fundamentally different from more volatile cryptocurrencies like Bitcoin or Ethereum, whose values fluctuate, wildly based on market demand.
So reliability.
Exactly. The idea is to have the reliability and stability of traditional money, but with the unparalleled efficiency and speed of digital technology.
So given that stablecoins have been around for a while and the market has been growing, what were the specific political and economic pressures that finally pushed Congress to act now? Why this moment for federal oversight?
Well, it was really a confluence of factors. The sheer growth of the stablecoin market, as you mentioned.
Over $216 billion.
Right, $216 billion market cap, over 120 million monthly transactions. That certainly put immense pressure on lawmakers. There was a clear, pressing need to address the long-standing regulatory uncertainties that kind of stifled broader adoption by major financial players. Economically, the motivation was strong to foster genuine innovation in digital payments, offering transactions that are both faster and cheaper than traditional systems. But it also aimed to mitigate systemic risks,
Like Terra Luna again.
which were starkly highlighted by past failures like the 2022 Terra Luna collapse, exactly. And, to integrate stablecoins more securely and reliably into the broader financial system.
And it truly was a bipartisan effort, which is pretty notable in today's political climate. Can you tell us a bit more about the coalition that formed around this act?
Indeed, that's a powerful statement of unity, really. The act was introduced by Senator Bill Hagerty, a Republican from Tennessee, and co-sponsored by a diverse group, including Senators Tim Scott, Kristen Gillibrand, Cynthia Lummis, and Angela Alsobrooks, representing both sides of the aisle. The 68-30 Senate vote on June 17, 2025, included support from 18 Democrats, which really underscores that consensus. Now, there was some opposition.
Okay.
And the sources we looked at indicate it was linked to concerns over potential conflicts of interests, notably involving President Donald Trump's cryptocurrency ventures.
Right.
It's important, I think, to clarify for you listening that our role here is just to report what the sources state about the motivations and the votes, not to endorse any particular viewpoint.
Absolutely. Just laying out the context. So this wasn't built in a vacuum, right? Before the Genius Act, how did stablecoin regulation look, both here in the U.S. and maybe globally?
You're absolutely right. It didn't emerge from nowhere. Prior to the Genius Act, stablecoin regulation in the U.S. was primarily state-driven. That led to a kind of patchwork of varying approaches.
Okay.
New York's Department of Financial Services, or NYDFS, has been a significant leader in this since about 2018. They've long required USD-backed stablecoins to maintain full reserves and allow one-to-one redemption. They later clarified things, mandating monthly reserve attestations and timely redemption policies. Other states like Florida, Nevada, Utah, West Virginia, Wyoming, they've also implemented regulatory sandboxes to foster innovation while applying existing money transmitter laws. But the consistency just wasn't there.
So states were doing some of the groundwork, but it wasn't uniform. And what about internationally? Were other countries maybe ahead of the U.S.?
Yeah, globally, the European Union's markets in crypto assets framework, or MiCA,
Right.
along with regulations in Hong Kong and Singapore, have established pretty comprehensive stablecoin regulations. Their focus is on robust reserve requirements, meticulous liquidity management, and comprehensive consumer protections. Much like the Genius Act, actually.
Similar goals, then.
Similar goals, but what makes Genius distinctive is its unique dual federal-state oversight model, which we should probably get into. For instance, MiCA typically requires local incorporation of issuers. The Genius Act, however, offers more flexibility by allowing foreign issuers to operate in the U.S. under comparable regimes, provided they hold their reserves in the U.S.
Interesting.
This is a key differentiator that could promote international harmonization rather than simply forcing everyone to set up shop in the U.S.
So the first step in bringing order to that Wild West was clearly defining what we're actually regulating. No more guessing games. What does that specific definition of payment stablecoin mean for the broader digital asset space?
This clarity is incredibly important. I mean, for the entire digital asset ecosystem. The Act explicitly defines a payment stablecoin as a digital asset used for payment or settlement, redeemable for a fixed monetary value, and designed to maintain a stable value relative to a national currency like the US dollar.
Okay, pretty precise.
Very precise. And crucially, it then excludes things like national currencies, traditional bank deposits, and securities from this definition.
So it carves it out.
Exactly. This directly addresses prior regulatory ambiguity by distinguishing payment stablecoins from other digital assets that might otherwise be classified as securities or commodities, a legal gray area that really stifled innovation for years.
That makes sense.
This legal clarity is a huge step forward for the industry. It also specifically notes that algorithmic stablecoins,
Like Terra Lunis.
like the one involved in the Terra Luna collapse, yes, are excluded from this definition and are slated for further study by the Treasury Secretary, which indicates a cautious, deliberate approach to that particular more volatile category.
Okay. Now that we understand why this act emerged and how it clarifies foundational definitions, the real power comes in. Who can actually issue these stablecoins and under what authority? How does the act structure that? Is it all federal or is there a mix?
It's definitely a mix, and that's the truly innovative dual licensing framework we sort of touched on earlier.
Right, the dual framework.
This framework acknowledges that states like New York have been pioneering this space, but ensures that as stablecoins grow to systemic importance, they're not left to, that patchwork of regulations we mentioned.
Tactical.
It's a pragmatic nod to federalism while ensuring financial stability on a national scale. There are essentially two paths. The first is the federal path. This allows subsidiaries of insured depository institutions, IDIs think major banks,
Okay.
federally qualified non-bank issuers, federal branches of foreign banks, and even uninsured national banks to issue stablecoins under direct federal regulation. The primary federal regulators here would be the Federal Reserve or the Office of the Comptroller of the Currency, the OCC. The OCC, for instance, is the primary regulator for national banks, so their involvement here signals that stablecoin issuers under the federal path will be held to standards similar to traditional banks.
Okay, so if you're a big bank or a major financial institution, you go through federal channels. What about everyone else who might want to issue a stablecoin, maybe smaller players?
That's where the state path comes in. State-qualified issuers with stablecoin issuance of $10 billion or less can continue to operate under their existing state regimes, provided those regimes are certified as substantially similar to federal standards.
Oh, so there's a check.
There's a check. A newly established Stablecoin Certification Review Committee acts as a gatekeeper, ensuring state oversight is up to par.
Makes sense.
However, there's a critical threshold. Any state-qualified issuer that exceeds $10 billion in stablecoin issuance must transition to federal oversight within 360 days.
Oh, okay, so there's a limit.
There's a limit.
Yeah.
There are provisions for possible waivers, but the general principle is that larger issuers, those reaching a systemic scale, fall under federal purview. This ensures a consistent level of oversight as they grow to a size that could impact national financial stability.
That sounds like a pretty robust structure, balancing state innovation with federal stability.
Yeah.
So regardless of which path an issuer takes, federal or state, what are the non-negotiable rules? How do they back up their stablecoins, and how transparent do they have to be?
Right. The Act imposes really stringent requirements on all permitted issuers, regardless of their licensing path. First and foremost, they must maintain 1.1 reserves. 1-to-1.
The core promise.
The core promise. And using only high-quality liquid assets, or HQLA. Think of HQLA as assets that are super easy to sell without losing value, like U.S. cash, short-term treasuries, maybe maturing in 93 days or less.
Very liquid.
Very liquid. Demand deposits at insured depository institutions, overnight repurchase agreements, or government money market funds. This isn't just a technical detail. It's the direct answer to those Wild West failures like Terra Luna.
The safeguard.
It's the ultimate safeguard against the kind of depegging event that shook the entire crypto market just a few years ago. The goal here is to ensure that every stablecoin issued is fully backed by highly liquid, secure assets, minimizing that risk.
That's a huge step for stability. But beyond simply having the reserves, how does the Act ensure the public can actually trust that they're there? What measures are in place for transparency?
Good question. On the transparency front, the Act mandates monthly reserve disclosures. These must be publicly available and certified by the issuer's CEO or CFO.
Monthly, yeah.
Monthly. And for larger issuers, those with over $50 billion in market capitalization, an annual audit by an independent accounting firm is also required.
An external check.
An external check. This provides you, the user, with a clear, regular picture of exactly how your stablecoin is backed, allowing for that external verification. And finally, there's strict compliance with Bank Secrecy Act, or BSA, requirements.
AML, KYC.
Exactly. Anti-money laundering, AML, Know Your Customer, KYC, and sanctions compliance. Issuers must provide annual certifications that they meet these standards and demonstrate capabilities to respond to seizure orders, ensuring stablecoins aren't used for illicit activities.
So what does this all mean for the financial institutions and the wider market? Will we see more mainstream adoption now that there's this clearer framework?
Oh, absolutely. I think so. By classifying payment stablecoins as distinct from securities, commodities, or investment companies, the Genius Act resolves these long-standing legal uncertainties.
Remove the ambiguity.
It removes the ambiguity.
Yeah.
Think of it this way. For years, major banks and fintechs had to treat stablecoins like a hot potato, right? Unsure if they were a security, a currency, or something else entirely. Genius removes that ambiguity, effectively giving them a green light to build services on top of stablecoins.
Yeah.
This legal clarity is expected to drive significant institutional participation. We're already seeing reports of traditional banks, fintechs, even major retailers like Amazon and Walmart exploring stablecoin offerings.
Really? Amazon and Walmart?
Reportedly exploring them, yes. This regulatory certainty isn't just a green light, it's practically a red carpet for mainstream adoption.
And what kinds of transformative use cases are we talking about here? How would this actually impact people using financial services in their everyday lives?
The potential use cases are indeed transformative. You could see faster, lower-cost payments, making traditional payment rails feel sluggish and, frankly, expensive.
Right.
Imagine someone sending money back home to family overseas. With traditional methods, you're looking at significant fees and maybe days for the money to arrive.
Yeah, the wait times and costs are huge.
Exactly. With regulated stablecoins, that could shrink to pennies and minutes. That truly revolutionizes remittances and cross-border commerce. And within decentralized finance, or DeFi, stablecoins with this level of clarity could enhance liquidity and interoperability, fostering a more robust, secure, and integrated ecosystem.
Okay, consumer protection is always a huge concern, especially after the experiences many have had in the crypto space. What specific measures does the Genius Act put in place to keep users like you safe?
Yeah, that's critical. The Act does include several provisions aimed at protecting consumers. The primary one, as we discussed, is that 1.1 reserve backing with HQLA.
A foundation.
That's fundamentally designed to ensure easy redemption and significantly reduce the risk of stablecoin losing its peg. The transparency measures, Those monthly public disclosures and annual audited financial statements for larger issuers also give you more insight into the health of your stablecoin.
See what's under the hood.
See what's under the hood. There are also strict custody safeguards, limiting custody services to regulated financial institutions and explicitly prohibiting the commingling of customer assets with stablecoin reserves.
Ah, that's important. No dipping into customer funds.
Exactly. That's a critical point for security. It prevents an issuer from dipping into customer funds if things go sideways.
And so people don't get confused about who's backing what. I assume there are rules about how stablecoins are marketed. Can they say they're FDIC insured or something?
No, absolutely not. And that's covered too. The Act includes a strict prohibition on misleading practices. Issuers cannot imply federal insurance or government backing.
Clear lines.
Clear lines. And they must provide standardized disclosures to users about their redemption rights and any associated risks. The goal is to make sure you, the user, know exactly what you're getting into, with no false promises of federal guarantees that just don't exist.
But of course, not everyone is cheering universally, right?
Yeah.
What are some of the areas where critics still see significant gaps or concerns with the Act?
Right. This raises an important question. While the Act certainly brings crucial protections, critics, including prominent organizations like Consumer Reports, argue it lacks explicit protections that are standard in traditional finance.
Like what specifically?
Well, they're pointing to very real scenarios. For example, if your traditional bank account is fraudulently drained, federal laws like the Electronic Fund Transfer Act or EFTA provide clear avenues for recourse, dispute resolution, limitations on your liability.
Right, you have some protection.
You have protection. Or consider unfair, deceptive, or abusive acts or practices UDAP provisions designed to prevent predatory financial behaviors. With stablecoins under Genius, absent these specific provisions, what happens if an unauthorized transaction occurs? Who bears the risk? Who protects you?
That's a fair point.
These are the kinds of nuanced concerns that still linger for some. Concerns also arise about the potential for large technology companies to issue stablecoins without being subjected to the same rigorous banking regulation or privacy guardrails that apply to traditional financial institutions. That raises questions about data handling and market power.
And operationally, what does this mean for the stablecoin issuers themselves? It sounds like a significant compliance burden, a lot of new rules.
It is, absolutely. There are significant operational considerations. The Act imposes a 120-day mandatory application response timeframe for licensing. That means existing and new issuers alike need to move pretty quickly to align with federal or certified state regulations.
120 days isn't long.
It's not very long. For major existing issuers like Circle, which issues USDC, and Tether, which issues USDT, this act could mandate significant restructuring. For Circle's USDC, which already holds a large portion of its reserves in highly liquid assets, it might be more about fine-tuning existing practices.
Okay.
But for Tether's USDT, which has historically included things like commercial paper and other less liquid assets in its reserves, well, this act could mandate a significant overhaul of their entire reserve portfolio.
That sounds like a huge shift for them.
It's a massive undertaking, and while it adds immediate costs and operational challenges, it forces a level of financial prudence and transparency that the market has, frankly, long demanded. For smaller stablecoin projects or startups, the burden of these compliance requirements, from robust AML KYC programs to monthly attestations, might be a barrier to entry.
Could lead to consolidation.
It could potentially lead to a consolidation of the market around a few large, well-resourced players. But on the flip side, this regulatory certainty could also spur new innovation in areas like programmable payments, where businesses can now confidently build on a clear, federally sanctioned foundation.
Finally, if we connect this to the bigger picture, how does the Genius Act impact the U.S. on the global stage of digital finance? Does it position us as a leader?
Oh, the Genius Act is incredibly significant in positioning the U.S. as a leader in digital finance regulation. It could very well influence global stablecoin and even central bank digital currency, CBDC frameworks.
That's setting a standard.
Exactly. By
Sure.
setting clear standards for reserve backing and transparency, it creates a powerful precedent that other jurisdictions might emulate. And importantly, the Act's provisions allowing foreign issuers to operate in the U.S. under comparable regulatory regimes, provided they hold their reserves in the U.S., that promotes international harmonization rather than fragmentation. It encourages a more unified global approach to digital assets.
And how does this play into the U.S. dollar's continued global strength? Does it bolster it or introduce new dynamics?
That's a critical aspect. By encouraging the growth and widespread use of U.S. dollar-backed stablecoins, the act directly strengthens the dollar's enduring role in global digital finance.
That makes sense.
Given stablecoins' incredibly low transaction costs, often a fraction of traditional remittances, they could transform cross-border commerce and reinforce the U.S. dollar's position in international financial standards. It effectively digitizes and expands the dollar's reach, you could say.
So it's not just about domestic regulation, but setting a global example for a future where digital assets are both innovative and responsible.
Exactly. The Act's strong emphasis on anti-money laundering and combating the financing of terrorism, or AML-CFT compliance, along with promoting interoperability, aligns perfectly with global efforts to combat illicit finance and standardize digital asset regulations. You can expect the U.S. Treasury to coordinate with foreign regulators, potentially leading to reciprocal agreements that foster a more cohesive and secure global digital finance ecosystem. It's about building that future where digital assets are both innovative and responsible.
What a deep dive. So, to recap, the Genius Act of 2025 is a landmark effort. It brings much-needed regulatory clarity to payment stablecoins in the U.S. It introduces this dual oversight model, stringent reserve requirements, enhanced transparency measures, all aimed at fostering institutional adoption and, at least in part, enhancing consumer protections.
Now, as we discussed, some critics certainly see room for improvement on those consumer safeguards, particularly concerning liability and privacy.
Right. Ultimately, this act cements the U.S.'s influence in global digital finance and reinforces the dollar's digital footprint.
So, as the Genius Act moves toward full implementation, its success will really hinge on effective regulatory execution and how it addresses those remaining stakeholder concerns. But this raises an important question for you listening. As stablecoins become more deeply integrated into our financial lives, from paying for your groceries to sending money across continents, what new questions about privacy, innovation, or even national sovereignty do you think will emerge next?